Hello and welcome to Fintech Forward, a legal guide for busy fintech professionals, a podcast created and produced by K&L Gates. Each episode is designed to highlight emerging developments and cutting-edge advancements typically seen in the fintech space. We hope you enjoy our podcast.
Hi, and welcome to our Fintech Forward podcast. I'm Jeremy McLaughlin, a partner in the K&L Gates San Francisco office, and my practice focuses on payments and fintech, focusing specifically on emerging payments, digital payments, and cryptocurrency. And today's session is going to actually focus on cryptocurrency. And we're going to be speaking with Justin Wales, a partner in our Los Angeles and Miami offices. Justin, why don't you go ahead and introduce yourself and your practice?
Yeah, thanks so much, Jeremy. Justin Wales. I have been practicing law in the crypto space since 2014. The practice is quite expansive and grows every day to encompass all types of new technologies that stem from Satoshi's original vision of Bitcoin. So that includes things like centralized and decentralized exchanges, decentralized finance, all sorts of blockchain-based projects, and most recently quite a lot of NFT innovations.
Great. Thanks. So obviously the space can be wide-ranging and there are lots of topics to hit on. So I'll start generally at a high level. Just kind of your thoughts about the state of the cryptocurrency industry as a whole. Is it in a state of expansion, a state of stagnation, and kind of what are either the major hurdles it's facing or the components that are propelling it forward?
Yeah, it's a great question. You know, one of the issues that the industry as a whole has is we tend to lump everything that shares certain characteristics together as all being part of the same community or the same industry, when in reality, you're seeing a lot of different technologies develop and grow that are not necessarily interrelated other than sharing some technological features. So, you know, in taking this in part, I think the Bitcoin space and the idea of digital currency that is unconnected to state governments or federal banks is growing, and you're seeing a lot of adoption in the digital asset space. And you're seeing, you know, real nuanced conversations about how to regulate and how to think about that from a global level. You're also starting to see a lot of new investment projects and innovations in how we interact with and develop different types of investment strategies using these types of decentralized technologies. And that obviously has been growing quite a lot as well. And then lastly, because Bitcoin and other technologies that live purely in the digital world have demonstrated the possibility of something that is digital being both scarce and valuable, you're seeing that concept applied to all sorts of other types of industries. And then that's kind of getting more into the digital art, digital collectible space. And one of the interesting things about where I think things are going is, you know, the NFT world and the DeFi world and the cryptocurrency world are starting to reconnect with each other. You're starting to see different innovative projects become, you know, launching that are taking, you know, maybe it's a digital collectible that's an NFT, but maybe NFT is also a smart contract that allows you to stake the NFT on a decentralized exchange. So you're kind of seeing the mixture of many of these products. It's a really exciting time.
Yeah, that's a good point. Kind of the intersection of them coming back together. Just for, you know, some of our listeners may not be have as much knowledge, but they've certainly heard of NFTs, I'm sure. So, you know, can you explain a little bit about what NFTs are and why people are spending so much money for them?
Yeah, well, an NFT is just, you know, what we call a non-fungible token. So a fungible token is something like Bitcoin or something like Ethereum, which is every Bitcoin is going to be worth as much as any other Bitcoin. A non-fungible token is just a token or some marking on a digital ledger that is supposedly unique and tied to some external artifact. So often this is a photo or a video or some piece of digital art. It could be other things. There's NFT insurance contracts, for instance, which the token becomes a bearer instrument for this, you know, an insurance contract. There are a lot of different applications. At the end of the day, though, what an NFT is just a receipt. It's a receipt saying you bought something and that it's going to point to the item that you purchased. And sometimes that's an art, you know, piece of art, and sometimes that's a collectible, and sometimes that's just, you know, a few words written to a smart contract. So you raise an important question: is why are people purchasing them? And to some degree, it's because this is a completely new market and people are very excited about getting in very early. And there's a lot of FOMO and a lot of open possibility of where things can go in the space. But cores, I think you're seeing people who grew up in a digitally native world who recognize inherently that digital things can be scarce and valuable and rare. And they're trying to purchase things that they have an affinity toward. So in some ways, it's no different than the art market. Why do people pay millions of dollars for paintings? Because they think that there's a market for it and they want, the painting, sure, but as important to the painting often is provenance of the painting that demonstrates that they own it. And that's really about building a market. So it's a mixture of fundamentals and hype in the NFT space, certainly.
Yeah, that makes a lot of sense. And so, kind of like a piece of art, some people buy that as, well, they want to support the artist, but some of it is the value in an investment. And so to switch from kind of NFTs into cryptocurrency, which, as you know, kind of what my intersection with the digital asset space is mainly on payments and cryptocurrency. As I've followed the industry kind of the past several years, one of the major impediments I've seen on the cryptocurrency side anyway is kind of a lack of consumer understanding and an inability of consumers to use crypto in day-to-day transactions, as opposed to just viewing it as some sort of an investment vehicle. So do you see anything there changing? Do you see kind of new products being brought to market that both kind of make crypto more graspable for consumers and able to use it in everyday transactions?
Sure. And I think part of it depends on what group of consumers you're looking at. Certainly from a U.S. perspective, most people view Bitcoin as an investment vehicle and a hedge against inflation and a hedge against government-backed currencies. And that's probably going to be the case until Bitcoin offers, services and opportunities beyond which, something like a credit card processor or a debit card processor can handle right now. I don't have a problem when I go to Starbucks buying a coffee with my debit card. It's no skin off my back. However, there are things that I can't do currently with my debit card that I could do with Bitcoin. So, for instance, microtransactions. I can send you, Jeremy, right now, 5 cents worth of Bitcoin through its Lightning network for zero fee, and it's instantly settled. That opens up the possibility to a lot of different types of expressive and financial transactions that you can interact with and participate with online, including things like machine-to-machine payments and integrating into what we now call the metaverse. That being said, it's really seeing a growth and adoption outside of the U.S. So places like El Salvador, places like Brazil, places like in the Middle East and Africa, where there are countries that don't have the same infrastructure and banking infrastructure where everyone has a card in their pocket and can easily spend their money, or they're having to interact with a currency that is subject to much higher inflation than even we have at 5.2%. You're starting to see those countries interact with Bitcoin as a real day-to-day payment method. And I think what will probably drive adoption globally are those types of use cases, because they, for people in El Salvador who have to spend, sometimes 15 to 20% of money brought into the country through like a remittance service, Bitcoin really solves a big problem and adds value to the overall GDP of El Salvador.
Absolutely. And I think both internationally and in the US, we're starting to see kind of payment processors and payment networks dedicate large teams to figuring out how to kind of solve the everyday spend issue with cryptocurrency. So, we're both lawyers, so let's talk about regulation for a minute. This is at first many in the crypto space, not at first, some still think that cryptocurrency should always remain unregulated. That approach certainly seems to be changing. So what's your view on both? Do you think crypto will be fully regulated in the future? Do you view a distinction between certain cryptocurrencies, such as stable coins and other cryptocurrencies, or do you think it's better to kind of to leave it unregulated for the time being?
Well, it's not unregulated now. And I don't think most people think that there should be no regulations that impact these types of technologies. However, I don't think we should be looking to regulate something just in order to exert jurisdiction at an agency level or to say that we've regulated something. You really have to think about what is the harm that you're trying to prevent? What is the policy reason behind the regulation? So for something like Bitcoin is maybe like a good place to start. Sure, centralized intermediaries, centralized custodians should be subject to some amount of regulation because the harm to consumers rests in their ability to safeguard assets on behalf of others. We have regulation in place in other contexts. And it quite nicely applies to something like Bitcoin. It gets a little more challenging when you're looking at things like DeFi, like decentralized financial protocols, in which I might create an on-ramp to a network, and then on that network, individuals can, in a peer-to-peer way, interact with each other. Now, ongoing question about whether my creation of an on-ramp subjects me to liability and restriction for the activities that occur on the platform itself. And this is actually philosophically a very challenging question to answer is at what point do you punish people for creating the opportunity for individuals to interact directly with one another through technology? In some ways, it would be like, should we punish a an internet browser for granting you access to certain websites that may allow you to, on your own, commit an act that might be unlawful or outside of regulation? This is where I think there's quite a lot of thought that needs to go into how we regulate before we do. The other thing about regulation, and Commissioner Hester Pierce just the other day said this in a speech in Austin, at some point, regulations about investments do not take the form of investor protection, but take the form of preventing investors from opportunity. So as the world becomes more financialized, as individuals through these technologies are able to, deploy their own personal capital in ways that they think adds value to an ecosystem, I think we have to reevaluate from federal level and a securities level whether the restrictions that are currently in place on investment contracts and securities should continue to be in place. And then separate from that, whether the rules that were developed in, an analog society for what is or is not an investment opportunity are completely analogous to what current technology allows.
Yeah, and securities is certainly one of the big areas where we see a lot of discussion now about regulation and unfortunately regulation by enforcement. And another hot topic in the regulation space is money laundering. And that's, unfortunately, largely because I think people that aren't familiar with the space just think, what is cryptocurrency used for? Its sole purpose is illicit transactions. But, I think the flip side of that is, if you think about it, Bitcoin, cryptocurrencies, the transactions leave an electronic trail on the blockchain, unlike cash I go out and pull out of the ATM and can go spend on something that can't be traced. So if Bitcoin and cryptocurrencies do kind of leave this electronic trail that cash transactions don't, why is there such a concern about money laundering and ransomware? Is it regulators that just don't see that distinction or don't quite know how to use it yet?
Well, look, I think the fact is that because Bitcoin is so valuable and is completely digital, and a transaction can settle, essentially instantly compared to, a wire transfer. And it can be tumbled and kind of utilized in ways that are much easier than just, $1 million in cash in a duffel bag. Criminals use Bitcoin and other cryptocurrencies for crime. Now, if you look at the statistics, it's a very, very tiny amount of the overall number of Bitcoin transactions. And the most, prominent method for money laundering is still cash and U.S. bank accounts. So I think there's just overall a problem with money laundering, regardless of the technology that's being used. But I think if you really had an honest discussion with most police agencies, they'd say that they'd prefer to have someone launder money in Bitcoin than in dollars because there is this trail. And we know from public contracts that there are a number of crypto forensic agencies that have grown over the last several years that are now, valued at over $1 billion as entities that have government contracts with the FBI and the Department of Justice and state agencies. So it's sometimes a technical challenge to be able to trace where one transaction leads to another and to then tie that transaction trail to an individual, usually through an exchange or other on-ramp that requires KYC. But it's certainly possible. I will say this, though. Every time a new technology develops, it will be used by criminals in some way. But that doesn't mean that the underlying technology has no other use. The internet has been used for by criminals since its inception to defraud people, to commit acts beyond what the government would like. That doesn't mean that there's not a non-criminal benefit to the internet. In fact, as we've seen over the last several decades, the internet has become ubiquitous into all life, criminal and non.
Yeah, absolutely. I think it's a great point. And we can already see countless ways that the blockchain technology is usable outside of cryptocurrencies. All right, I want to end on one final question. Let's talk a little bit about cryptocurrency vis-a-vis traditional financial institutions, such as banks and credit unions. We've seen more and more, especially from the OCC anyway, in the last year or so, them coming out and issuing letters discussing the authority that national banks have to deal in digital assets. Do you see opportunities for kind of those traditional players to get involved with crypto? And if so, kind of in what ways and what are the benefits that the two sides could work together?
Yeah, I mean, I think what you'll end up seeing over the next several years is that there's not really going to be two sides. I think the traditional banking world has been shown that there's a technology that is making the cost of entering into a financial society, much lower, and that they're going to have to be forced to adopt the technology and the idea of cryptocurrencies in some way. So whether that's bank-to-bank settlements, which is something that a lot of people propose, or whether that's just more and more of their customers are going to start interacting and investing in and wanting to use things like Bitcoin for both investment and day-to-day purposes, I think you'll see banks embrace this and at least start to get comfortable with this. And you're already seeing it. A good example is El Salvador, what happened in El Salvador recently. The government of El Salvador basically said, we're going to make Bitcoin legal tender. All merchants have to accept Bitcoin. The reason they did this is because most of the GDP, or a big portion of the GDP of El Salvador, are actually people who have left El Salvador and are sending money home. And because that they have to deal with payments processors who take sometimes 10 or 15%, the overall GDP of El Salvador takes a hit because they're forced to use this legacy system. So what ends up happening? They encourage everyone through a government incentive program to download a Bitcoin wallet. They give everyone $30 for that Bitcoin wallet. In 1 month, I believe it was something like 2.3 million El Salvadorians had Bitcoin wallets and Bitcoin accounts. There were only 1.8 million, I believe, El Salvadorians who had access to bank accounts. So instantly, you saw normal people in El Salvador who would have otherwise not had access to a global financial system instantly have access to that system. And my guess is that traditional finance will realize that there is an opportunity to have customers, to have interactions with, to offer services to this world of unbanked individuals. And I think that they'll have no choice but to embrace it in the same way that the telecom companies embraced the internet when they fought it at first, and the cable companies embraced streaming in some ways.
Yeah, absolutely. It's almost too big to be ignored. Well, thank you so much, Justin. This has been fascinating. We obviously could continue on for much longer. Thanks so much for your time.
Yeah, my pleasure.
Thanks again for listening to Fintech Forward, a legal guide for fintech professionals. New episodes are available for download through iTunes, Google Play, and other podcast applications. By subscribing to Fintech Forward, you will receive timely notifications of each new episode. Also, if you have any topics that you would like to hear discussed, please email fintechforwardsupport@kalegates.com. We would love to hear from you.